So Matt Piepenburg and myself, we're back with another MAMChat. I'm right now in Sweden, and the view you can see behind me is actually the Baltic. This is a virtual picture, but this is the view I have. And the Baltic, Matt, is not always as calm as on this picture, because it is a sea, not a lake. It's a proper sea, the Baltic. So anyway, Matt, we've talked about before what the new leadership, which I call BY or BY, Biden, Yellen, what mishaps or what, let's first say, be positive. Let's say what fortunes they can create, and what problems we are likely to see that they have to tackle with. Yeah, I think you have some views about especially Yellen, who's been around for a while, and now in her new role, what do you see that she's going to do?
Yeah, you and I have spoken with an attempt at impartiality on other former Fed chairmen or chairwomen, in this case, Janet Yellen. We've poked a little holes in some of the themes of Alan Greenspan or Powell or even Bernanke. And I thought it'd be fair to not forget Janet Yellen, who's now, of course, a Treasury Secretary, having gone from the Fed and the private sector into the public sector of the Treasury Secretary as a Politico. I wrote about Janet this week only because I was thinking about something she had put in the Washington Post, an op-ed back in 2018, in which she described the potential for a debt crisis in the U.S., which I thought was very rich because I think by 2018 we were already in a debt crisis. That came out in the spring of 2018. By October of that same year, we had a little hiccup in the Treasury market. Quantitative easing kicked in again at about $60 billion a month in October. Although they didn't want to call it quantitative easing, that's exactly what it was. This wasn't under Yellen, of course, was under Powell. But Yellen had kind of foreseen this, or that there was going to be an issue. And then, of course, a year later, in September of 2019, we had a major crisis in the repo markets, and the Fed had to step into the tune of many figures to help out, provide liquidity for that. So I thought it was ironic that Janet Yellen was talking about heading towards a debt crisis when we were already in a debt crisis. I think what's interesting is you fast forward today, Egon, to Janet Yellen as a Treasury Secretary. We have to go back to tweets now to get our information from, I hate to say it, twits, but I don't want to be too crude, but Janet Yellen now says we have to re-examine our policy on fiscal spending. And as we've done with Bernanke and Powell and Greenspan, I think it's important to translate what a Politico or former Fed chairperson says in English into basic English. And by rethinking fiscal policy, all that really means, in my opinion, and frankly anyone else's who've been watching this, and you included, is that just means much more fiscal spending. And as we've talked about, money printing or debt has consequences on currencies and has implications for inflation. And if you're going to have serial stimulus in the form of fiscal policy, which is what Janet Yellen has been tweeting about pretty consistently, that just means more fiscal spending, which I think is incredibly inflationary. And as usual, whether she's wearing a political hat or a Fed hat, the problem facing DC in general, whether it's at the Eccles building or at the Treasury Department, is very simple. They have too much debt. The only way to sustain that debt is the creation of more money and the creation of more IOUs from the Treasury Department, and paying for that with more printed money, all of which is, again, very, very inflationary. I wanted to put Janet Yellen into perspective and then go back to some of your points, because you've talked about inflation and hyperinflation. And recently this week, you wrote a very compelling piece on the Hocus Pocus magic of just printing money to solve problems, to create more debt, to solve old debt. What are your thoughts on inflation, Egon, today? They're not different, but I like, including hyperinflation, which many people think is exaggerating or is sensational, when in fact, it really is nothing new under the sun. But I wanted to get your perspective on that.
Well, yeah, I think your point you made on Yellen is very interesting. First of all, the leaders that are elected for a certain period, like Yellen here, those leaders are instruments of their time, which means that they're actually there to fulfill what was going to happen anyway. So we know that we are at the final period of a monetary era now, because that's what history tells us. We've had 100 years in this particular era, and that's a pretty good period to actually see the end of the era, whether it happens in the next 5 years or it takes slightly longer. Nevertheless, Yellen is the perfect instrument, and she's the perfect one to fulfill this, my scenario that I call hocus pocus. So this is a hocus pocus scheme. Whether you call it MMT or QE, it's all hocus pocus because there is no reality whatsoever. And we know that they are using hydrogen and oxygen to thin air, to create money. And that can never work, of course. So therefore, this is the final act of desperation. And what always happens, Matt, in the final period, and we can compare this to the Roman period, 180 to 280 AD, for example, when the denarius went from 100% silver content to 0%. And this is the same. We're down 97% roughly on all currencies, including the dollar, in the last in the last 50 years, in 71. And now we're looking at the final fall. And in my view, hyperinflation is inevitable. Nobody sees inflation, and a few months ago everybody thought it was impossible. Now some people are saying at least we have some inflation, which is clearly happening, but it's still at a level which is 1 or 2% or 3% or whatever, which is nothing. But as we both know, hyperinflation happens when it's a currency event. So that is when the currency collapses. That is what creates hyperinflation, not high demand, not lack of supply or deficit of material. So hyperinflation is therefore very likely, because we are now, the final money printing that I see in the next 5, maybe 5+ years is going to be accelerated to an extent that will create first inflation and potentially hyperinflation. The currencies have already fallen, as I said, and they will continue to fall dramatically to make that happen. So it's a very easy historical forecast that I would say the accuracy is 100% certain, but the timing never is, of course. So whether it takes, as I say, another 5 years of this era, or it takes 10 or slightly longer, it's irrelevant. That's the risk that investors have to focus on today. And as we know, you don't worry about risk when it happens, you worry in advance. And that's why we are so much concerned, Matt, about wealth preservation and about investors actually looking at insuring against this risk today. And of course, as most people know, we see gold and silver being the best forms of insurance, physical, of course, since they actually are the only ones that throughout history that have maintained stable purchasing power.
Yeah.
But you know that there are so many factors that now are going to play in the next few years here, which is currencies, inflation, etc. So how do you see? People are, of course, very interested in interest rates and in the short-term movements of interest rates, although we are, as a company, we are really more focusing on the longer than the short-term. But people always like short-term views, whether we will be right or not, but we still have some views. So what do you see the short-term situation, how that will evolve?
Sure. I mean, the interest rate topic is highly aligned with the inflation conversation, especially when you're talking about precious metal prices or precious metal direction, which we've talked about in the past. When inflation outpaces the yield on a 10-year or the interest rate of the current providing interest rate, usually that's a negative number. And the more negative that real interest rate becomes, the bigger the tailwind for gold. It's important when we talk about interest rates to go back to this inflation topic in general and Yellen in particular. Again, serial stimulus, fiscal stimulus is far more inflationary than just monetary stimulus, because the monetary stimulus stays behind the Hoover Dam of the Fed and the commercial banks and the Treasury. The money that's created to go right into Main Street of the middle class under the stimulus programs goes into the real economy. That's highly inflationary. And I think that means inflation is going to rise. The Fed and Powell, and now course, Yellen at the Treasury is saying that's transitory inflation. These are words like temporary. Let's remember Nixon said going off the gold standard was temporary. Bernanke said QE1 was going to be temporary. The word temporary coming out of DC has no merit.
But of course, if I interrupt you, some of the inflation we're seeing now is not the inflation we are talking about. No. We are talking about a currency influenced inflation due to massive increase in money supply. But the inflation we're seeing now, much of that is, of course, the fact that there has been a shortage of supply in many areas due to COVID. From raw materials to the manufacturing process, and we see that everywhere. You see that, and then everybody comes out of prison, having been in quarantine or locked up or locked down with COVID, and everybody seems to be, especially the people who have some saving, they want to be spending that money. So there's a shortage of a lot of products short term. I mean, take here in Sweden, you can't get a pleasure boat or a leisure boat this year. There's nothing in stock. Price of puppies in Sweden, in England, in Switzerland have doubled, etc. So that's a short-term inflationary effect. But of course, we are not talking about. So that's what we're seeing now. But you're really talking about, the longer term, the effect that we will see from the money printing rather than from
absolutely. The real definition is money supply, the broad money supply increase per capita. It's less and less to do with the CPI measure, which is making headlines this week because we've had a 5% year-over-year increase, a monthly increase of 0.6%. Again, they're trying to calm that down. The Fed wants to have its cake and eat it too. All the central bankers do. They want to have more inflation to get out of debt, but then report it low on a bogus CPI scale. And, this goes back to the inflation question, which I want to get your opinion on too, or excuse me, the interest rate question, because inflation interest rates are important for gold price, especially when inflation outpaces, however inflation is reported accurately, inaccurately, when it outpaces interest rates, we have a tailwind. And I see a perfect setting, as I've said for months, for gold going forward the next few years, because I do believe they're going to target higher inflation. They have to get out of debt, but they want to have their cake and eat it too. As they're issuing more debt, they have to keep interest rates low. And that's my view on the near term. And I think Powell has pretty much confessed as much that, we are in a major debt crisis, he said, but not to worry as long as the cost of debt is fine. We'll worry about growth later. And now Yellen is saying the exact same tune. She's saying the exact same tune from the Treasury Department. Olivier Blanchard, who was a former chief investment officer for the IMF, has said the same thing. They're admitting that debt's a problem, not to worry, we're going to keep interest rates low. So I see a real scenario where you have rising inflation, however it's reported or measured by the politicos or the policymakers, and an unnaturally, artificially repressed interest rate environment. Because of the debt levels we're at today, they can't allow it. They can't allow rates to go up. The question is, can they control that? And can they pay for this? And, Yellen's already signaling her meetings with the IMF and a new Bretton Woods and a new digital currency and a new direction in cooperation with the IMF, is as if the COVID crisis was as bad as World War II and the need for the Bretton Woods.
But of course, my view, yes, I mean, I agree with that. And my view on interest rates is that, of course, central banks and leaders of various countries have to fight tooth and nail to keep interest rates down, because you talk about, U.S. debt being now 85 trillion and nearing 90 trillion total U.S. debt. Yeah, totally. Global debt being 300 trillion, having gone up 3-4 times in this, or more than 3 times in this century. And of course, the world couldn't afford even 1% increase in interest rates. Never mind increase to the levels that we saw in the 70s, which I remember very well, when interest rates went up to high teens or even 20%. So, and therefore, they have only one choice, and that is to push them down for as long as they can. But I am of the very strong opinion that as money printing increases, that there will be a problem in the debt markets, and the long end of the debt markets there'll be pressure. People will be selling, especially the long end, which is less. They have less influence over the central banks, and therefore I think as the long end will start going up, and this is what we've seen with the 10-year now, And the 5-year having gone up, the 10-year having gone from 0.5% to 1.7%. And I think we will continue to see that pressure. I mean, there'll be ups and downs. It won't be straight, but and then in the end, the long rates will pull up the short rates, and then we will get into a debt crisis, because if interest rates go up, if there's a really pressure on bonds and people start dumping bonds, and bond rates go up dramatically, I mean, that's the end of this of this debt market, the total end. And I don't see
Either
how.
Way,
Go ahead.
Either way, I see inflation outpacing rates. Even if rates spike, it'll be because inflation is going to be spiking. And I think real quickly, Egon, just because I don't want to take up too much time on the video, is, excuse me, we wanted to talk about this inflationary effect and the effect on the gold price and the tailwind scenario when inflation outpaces interest rates as it's doing. And yet gold is steadily trying to reach back to its last year's highs or last summer's highs. And we see a lot of pressure in the COMEX market to put the boot to the neck of the gold price, or the paper gold price. We even see Macron saying they're going to sell some of the French gold to help Africans' issues in Africa, or policy issues in Africa. That's going to put selling pressure on gold. There's a real fear to see gold rise too high in the face of fiat currencies. In the meantime, and it's a more complicated question, Basel III is making the headlines. We've talked, and you've written a little bit about this in the past. Do you see any significant changes in the next 6 to 12 months in the COMEX market, or the regulations of the derivative market in gold and silver, that could have a near-term impact on gold or silver prices? Because there is thought some changes are coming this way.
Yes, well, of course, Basel III requires then all the bullion banks to hold gold, physical gold, in their own vaults. As reserves. That's the only thing that will count as a tier 1 reserve, 100% physical gold. And now, of course, they have mainly paper gold. And the date is 30th of June for European banks, and end of December for UK banks. In my view, some people are writing about this, saying that's going to create panic and a lot of demand for physical. I think that will be fudged in the short term, because otherwise the market would have been a lot higher already. I don't see gold going up dramatically in the next couple of weeks just because of this 30th of June. But we have to remember that it will happen sooner or later, but there might be a 6, 12 months or longer transition period. But we have to remember that gold is in a very strong uptrend. We have an uptrend since 2000. That uptrend stopped temporarily in 2011 and 12. We had a correction to 13 to 16, depending on when we count the bottom. Now we resumed the uptrend again. And remember, when we, it wasn't more than a bit over a year ago, we were down at under 1300 for a long time, and then it broke that what I call Maginot line, we saw it going up to last August to 2000, and now we've corrected for a few months. But again, remember, end of March, gold was just under 1700, but now it's 1900. So we're already up $200 in a few weeks. The trend is up. The trend is strong. It's not going to be straight up, and 1900 is a bit of a resistance level, because that was support level about a year ago when gold had peaked. No, it was actually in September, October last year, gold had peaked at 2000 and came down to that level and held there for a while. So these support and resistance levels sometimes stop the move for a while. But the gold is in an uptrend. Gold is going to move up strongly, whether it happens tomorrow or in a week's time or in a month's time, doesn't matter. But we as wealth preservationists, Matt, as we know, we are not looking at timing short term. This is not trading. You don't have to get in at a very low level and try to fine tune your purchase of gold, because most people who do that will miss it, because they will wait for it to go down, and then in the end it goes down, and then they feel, well, I'm not going to buy now, it's going down, and then it starts going up again, and then they think, well, it's too high. That is a wrong mentality to have when you are acquiring gold for wealth preservation purposes. You don't have to worry about the short-term price of gold when you buy it for wealth preservation purposes, because central banks and governments will do the work for you, because you know that throughout history they have always destroyed the money, and they're doing it this time too. So whether you are wrong slightly in the short term doesn't matter at all. The most important thing with insurance is to buy your insurance, put it aside, forget about it, don't look at the daily price, and that's the purpose that gold serves. And therefore, the beautiful thing is you don't have to worry about the short-term price. You just buy it, and then you're happy because you're protected. And that's, I think, go ahead. Yeah.
No, you can't overstate that enough, and we can't overstate it enough. This is not a speculation trade. This is a preservation movement. It's an objective policy that you have to make personally for yourself, as the rest of the policymakers make it easy for us in the global setting. And
absolutely,
can't overstate it enough.
Yeah. Right. So I think that's it for us today.
Okay, Egon.
Matt, and speak soon again. In the meantime, thank you very much for listening. We'll be back. Bye-bye.
Okay. Talk to you soon, Egon. Bye-bye.
Bye.